For more on where the money is flowing as we wrap November and head into the final month of the year, David Sowerby is portfolio manager at Loomis Sayles. He joins us from Boston.
Hello, Mark.
David, thank you so much for joining us.
Absolutely.
We appreciate it. Let's start with this UAE story because it's one that's been dominating the news before we get into some other things. Do you see that the Dubai debt crisis impacting the U.S. markets today?
Frankly, very little. And when you put it in perspective to some of the foreign contagion we had either in the fall of 1997 or the late summer of 1998, on a relative basis, this is quite small. I think the market is reacting today to the news that it's relatively self-contained. I'm not turning a blind eye to the fact that it still could be problematic, but compared to 1997, 1998, this is very small.
Are you saying that it's self-contained because the UAE central bank saying that it would step in and backstop this?
That's partly it, as well as just the relative size of the economy compared to what we saw, whether it was some of the Asian problems in the fall of 1997 or the Russian default in late summer 1998. I think it's relatively small compared to those issues, which did create 10 to 15% or more drop in stock prices at the U.S. level.
David, could this, though, be a catalyst for investors around the world to start thinking about paring back their risk, maybe start taking some profits?
I think potentially, yes. But as you look at the U.S. stock market, we have recovered about 50% of the original bear market decline that prevailed in 07 and 08. So we still have more ways to go. Stocks aren't obviously as attractive on a valuation basis as they were in March, but nevertheless, there's still some compelling valuations out there in the market that I think make investors still hungrier for stocks than less so over the next 6 months.
Let's talk about the other theme driving U.S. stocks, at least a lot of people are saying a little lower here, and that is consumer. That shopping over this all-important holiday weekend was a little weaker than anticipated. What's your take on the consumer and the consumer's role here through the holiday season and what it's going to mean for the markets as we wrap up 2009?
Sure. It's very easy to say that the U.S. consumer is still going through the pain and the deleveraging that they've witnessed for the last 12 to 18 months. However, when you look at the relative larger picture of the consumer relative to very low consensus expectations, the consumer could surprise us modestly on the high side in this holiday shopping period. I found over the years we probably put too much weight on Black Friday and not enough weight on the rest of December, and indeed even into early January when those often used gift cards get redeemed. In the end, I think it's probably holiday shopping on a same-store basis that's up 2 to maybe as much as 3% compared to last year's depressed levels.
And David, do payrolls have anything to do with this, with the last day of November today being on a Monday? Does that factor into this?
It certainly could, and there is a definite link between employment, unemployment, and confidence, all still showing a show-me sign for the consumer. However, when you look at still some of the valuations within consumer stocks and the fact that obviously they've had a good 8-month run, but those runs usually last 9 to 12 months, there's still some opportunity out there in the consumer sector, especially if we get some sort of a near-term hiccup in stock prices.
So are we getting a sense, I guess Lori, touched on this a little bit, are we getting a sense that consumers are now starting to take some tentative steps back into stores, back into the shops, and deciding, well, maybe I've been pretty good this year because of all that's going on with the economy, don't know for certain whether or not I'm going to keep my job, I need to pay my mortgage or my rent, I've saved a little bit, so now I've been pretty good, I'm going to treat myself, maybe I'll buy that big ticket item right now.
Well, they certainly bought the big ticket promotional item on Friday and Saturday, but I think when you look at first employment, that's still a red flag for the consumer. But I think what's still discounted is the fact that holiday shopping is definitely linked to stock prices, and stock prices we know have rallied more than 60% off their March lows. That's had a positive effect at the retailers, particularly some of the higher-end department stores where you're seeing better sales numbers than expectations of a couple months ago. One stock we like in the smaller cap area that we've talked about before is Fossil, which is the watch company, as well as leather goods. The CEO has a definite link to creating shareholder value. The valuation is still relatively compelling after a longer-term run over the last few months. There's an idea, I think, on the consumer side where there's still opportunity opportunity on the upside.
David, among your key 2009 themes are overweight small caps. You mentioned fossil. Are you going to stick with that into the new year? That's worked out pretty well for you so far.
It's been a good call, and it's been an 8-month rally. And traditionally, when you look at the excess return that small cap stocks have generated to large cap stocks off of bear market bottoms, it typically lasts 12 to as much as 24 months. Now, this quarter, small cap stocks have given some ground back to large cap stocks, but I think over the longer term, there's still an opportunity here that in a small tilt in portfolios, I want to look at opportunity in the small and the mid cap sectors.
David, let me ask you about a story that we have on the Bloomberg terminal today. A lot being made of the fact that hedge funds are shoveling money right now into stocks. Individuals are exiting at the fastest pace. What do you make of that?
I think they're probably closer together than maybe we might realize, and that is that it's good that hedge funds are now going more net long in their portfolios based on surveys.
What's it mean for the S&P going forward?
Well, it's I'd rather have net long, obviously, than net short. But I think for individuals, for that concern of that, the fact that individuals have been taking money out of the equity markets and putting them into great yield opportunities in the fixed income markets, that individuals today, about over 40%, still say that they are bearish. And that's higher than the longer-term averages over the last 5 to 10 years. And I think from a contrarian perspective, you will begin to see, still on the margin, more individual investors be tepid, but nevertheless positive, net buyers of equities as I look out over the next couple of quarters. So I think it's positive that individuals aren't too bullish on stocks, that they can be net buyers.
And we'll leave it there. Good place to stop. David Sowerby of Loomis Sayles, portfolio manager, many thanks.